Welcome to part 3 of this series. This is going to be the final installation of this series on RSI indicator trading strategy. And in the first 2, we covered some good ground. And today I promised that I'm going to show you how to really make the RSI indicator a momentum indicator, because even though it's called a momentum indicator, it's really not. So I got a little controversial there with you, and got a lot of emails, by the way, from this last video. Most of them very positive, a lot of them asking, hey, where's part 3? And so a lot of people looking forward to this, so here it is. Okay, so the reason that RSI is not a momentum indicator, just for review, is because momentum requires mass. Momentum is the product of mass and velocity. And RSI really only measures velocity or rate of change in a particular way that it was calculated according to the special formula. But it does not include mass, or, as we refer to in the markets, volume. So in the markets, we equate mass with volume, and the RSI does not take that into consideration at all. Therefore, that's why I say, controversially, it's not a momentum indicator. So here's the RSI, it's the blue line. Now, below it, I have put a different indicator, MFI. That stands for Money Flow Index. Now, the Money Flow Index is also an oscillator that goes between 0 and 100. Some people refer to it as a volume-weighted RSI. So it does incorporate volume into the RSI indicator. Now, you'll notice that actually it's very similar, it moves in very similar ways, but there are some times when it is quite different, and those are the key times. So, for example, let's take a look right here. We put in a high on the market. By the way, this is my rubber band trade. If you want my rubber band trade, I do offer that trade set up for free, and a little more than I can go into right now, but I've got a video that shows you how to trade that set up in about 26 short minutes, so feel free to go ahead and click on the box in the top left corner there, and I'll get that to you. So notice how in this situation here, the RSI is still going up, but the MFI is trending down. That means that there's a lack of volume pushing this up. So velocity is up, but actually momentum, when you incorporate the volume aspect of it, is down. And therefore, in my opinion, the MFI gives us a much better signal here, saying this is moving up on weakness, and therefore we can expect a high and come back in the direction of the trend. This is the 50-period simple moving average. That's our overall long-term trend indicator. So to me, this gives us a better signal saying that, oh, okay, we're doing a retrace here, but that move up is on weakness, therefore I don't expect the trend to reverse and go up. I actually think that's just a complex retrace up in an overall downtrend, which is exactly what it was. So by incorporating volume, you see the weakness in the up move, whereas just with the RSI, without the volume incorporated into the formula, you don't see that. You're blind to that. Now, to support the last 2 videos, I wanted to say that even with the MFI, as I already said with the RSI, just at reaching these so-called overbought or oversold areas, typically 70 and 30, does not mean you're putting in a high and that you should go short. It's not really overbought here. So the market continues to go up, make a higher high. Well, guess what? The same applies with the MFI. So here it gets well over, in fact, it gets even a little more above 70 than the RSI does, and then the market still continues to go up. So I would only take this, personally, trading in the direction of the trend, not looking for reversals, not looking for trend reversals. A lot of people actually do say that the MFI is better than the RSI, looking for trend reversals. And they'll add some other qualifications in there, well, which is good. Sometimes they'll look for divergences, things like that. Personally, historically, I have not seen that to be very accurate. So I only use it to trade in the direction of the trend for trend continuations. Now here's an exception to that rule. It's not really an exception to the rule. It actually supports the rule I just said. But it kind of combines the two, which is very interesting. So here we have a situation where we do get the indicator being oversold, reaches 30. That's the magenta dashed line there, of course. So, but here's the thing. we're in an uptrend. You see, we're in an uptrend. So the one time that I would look for these extremes, these overbought, oversold conditions in order to take a trade is only if we're oversold in an uptrend, or conversely, if we're overbought in a downtrend. So still, I'm looking for a trend continuation though. That's the key. I'll give you one last little tip here, and again, it's still for trend continuations. Now, another signal that you can use to get back in the direction of the trend, so here we have an uptrend that started, and you can draw trend lines on this thing. And if you draw a trend line on it, see, it works a little better than with the RSI. It's just, again, it's forming a different pattern here. So if you form a trend line there and you wait for the breakout of the trend line, that often indicates a shift of momentum. In other words, we want to be trading a strong trend, not a weak trend. So we want strength to come back into this trend. And there's a couple ways. You can just do it on the break of the trend line if you want to, or some people will draw a line above these highs, wait for the price action to actually break out above there, but only if it's accompanied with the break of the trend line. So same thing here. So we can draw a trend line there, and then wait for the breakout here. Now, if you wait for a breakout, if you get the breakout here, then I wouldn't wait for it to break out above that high. I would say, well, put it in here. But then at the same time, you want to make sure, again, trend continuation on strength. See, if you drew it on the RSI here, it didn't really work out quite as well. It would have come in on this low, and I guess you'd be okay. But again, it's just a matter of the MFI incorporating volume, making it more literally and accurately a momentum indicator. So test it out for yourself. Don't take my word for it. Put it on your charts, paper trade, swing or demo trade with it for a little while. See if you like it. And if you do, great. And if you don't, that's all right. There's plenty of other great indicators out there. So if you like this video, then please understand it's not actually free. I mean, yes, it's free here on YouTube, but if you got value from it, you have a moral obligation to pay it forward by clicking on the share button below and share it on social media. Also, if you're watching this video on YouTube, please click the thumbs up icon and leave a comment, because that really encourages me to, well, create more free tutorials for you. Also, as I mentioned earlier, I'm giving away one of my favorite trade strategies, the rubber band trade. I trade this thing usually 2 to 3 times every day. It has a real high win-loss ratio. It's a trade that works now, and it's a simple trade. You can learn in about 26 minutes. So get the video explaining that trade strategy absolutely free by clicking in the image in the top left corner, or if you're on a mobile device, click the little eye with a circle around it in the top right corner of this video. And if you're not watching on YouTube, there's probably a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.